light of day with a clear head and time on your side rather than under the gun as events unfold. If you've decided to let your financial advisor make your investment decisions, then it's a good idea to specify what risks you're willing to take and which ones you want to avoid. This will probably be vague because people define risks differently. At one end of the spectrum, you can try to list everything that is acceptable or unacceptable. At the other end, you could just specify the maximum loss that you're willing to tolerate. For example, you could say that any loss of 30% relative to last year's value requires the manager to get you into riskless assets immediately so that you don't lose any more than that. Lots of people have more than one account with a financial institution. They have a checking account, a CD, a brokerage account, and whatnot. These days, it's easy to transfer funds from one to the other. Depending on your needs, you might want to specify which assets the advisor can touch. Maybe you're willing to let him sell shares without your approval under certain circumstances, but you don't want him dipping into your cash account to buy shares without your explicit permission every time. Whatever you want, spell it out. Do you want your advisor to consider your tax position? For example, you might want him to sell your stocks that have declined in value so that you can claim the tax deduction, but not until they've declined, say, 20%. You might want to focus on high dividend stocks in a tax-exempt account, but invest for price appreciation in the rest of your portfolio. If so, state it in the IPS. How much trading will you tolerate? Trading entails fees, so even if you think that your advisor can pick winners, you might want to restrict the amount of trading he's allowed to do on your behalf. Don't pay for services that you don't want or that you won't use. An IPS probably should identify benchmarks, especially for an actively managed account. What will be acceptable portfolio performance? Should the manager beat the S&P 500, or should he just index your account to match it? Or should the benchmark be some other index? Some policy statements even specify different benchmarks for different portions of the portfolio. For example, the part of the portfolio in large companies might be pegged to the Russell 1000 index, which contains the companies with the largest market value, while the part in small companies might be pegged to the S&P 600, which contains much smaller firms. When I made my own investment policy statement, it boiled down to, I want to make my own decisions, I don't want to be bothered with phone calls or email, and I want to pay the smallest fees possible. An investment policy statement doesn't have to be complex. Whatever steps you take along the road to choosing a financial service provider, remember the bottom line. Only you know when you feel comfortable with a financial services firm and the person handling your account. Choosing the right broker is much more important for investors who believe in active management than it is for passive investors. If I'm a passive investor, then I'm mostly interested in the fees I'm paying because my investment returns will depend almost totally on how the stock market behaves. An active investor will be trading lots more frequently. The success or failure of those trades will swamp the fee structure. If active management adds 10% to my portfolio returns, then I'm not going to be too unhappy if the trades cost me 2%. On the other hand, if active management subtracts 10%, then I'm going to be mad. Incurring all those trading costs just to be down 10% more than the market is tough to take even if the manager waives his 2% fee. Fees come in all shapes and sizes. We've all heard of commissions. They can be rather hefty. Some brokers charge over $30 per trade. Others charge much less, and some even offer a limited number of free trades per month for investors with some balances over some minimum amount, like $20,000. Depending on the makeup of your portfolio, though, that minimum balance might be a hidden fee. If it takes a $20,000 balance to get the free trades and you have that much in stocks, then fine. But if your account has